Inflation has been one of the hottest topics dominating the headlines for the last 2 years. And while inflation is a big problem for the economy, there's a few ways it can benefit you as an investor. In today's video, I want to highlight a few ways that real estate can help you hedge your investments against inflation. So in 2020, when shutdowns from COVID began, the Federal Reserve brought interest rates all the way down to zero because they were fearing a big recession. The problem is that in an attempt to prop up demand with free money, simultaneously we were in the midst of a huge supply crunch due to these shutdowns because nothing could be produced. Trillions of dollars later, we found ourselves in the worst inflationary period since the 70s. This makes it hard as an investor because what's literally happening is your dollars are losing value faster than they're growing. If inflation's at 8%, you need to generate returns above and beyond 8% to get ahead. In this circumstance, real estate becomes an attractive option for a few reasons. First, if you're invested in rental real estate, historically, rents tend to keep pace with inflation. Specific to multifamily, leases renew every 12 months, allowing for a reset based on other rising costs. And the common question I hear to that is, well, isn't the growth in income just offset by those rising expense costs, which would result in a wash? While expenses definitely increase with inflation, they're a fraction of all of the income collected at a property. So if expenses increase by 5% and then that same 5% is applied to income, because our income is so much higher, the end result is actually a net gain. The second way real estate hedges inflation is that when costs rise substantially in the marketplace for labor and materials, this results in less construction. Less construction is going to lead to tighter supply, which in turn puts upward pressure on rents. Even when these projects do push through and end up coming to market, rent prices are going to be aggressive in order to justify that project's cost, leading to more affordability for our invested asset and further appealing to consumers. The last way you're protected from rising inflation in real estate is related to debt. And as you know, most real estate transactions happen using a loan. And with that loan, especially when the rate cannot adjust over its term, the outstanding balance is slowly being eroded away by increasing inflation. To use an extreme example and drive the point home, let's imagine you own a $10 million property and it has a $5 million loan on it. And let's say this property is making $500,000 per year. Over the course of the next few years, inflation ends up totaling 50%. Well, as we've kept pace with inflation through rent increases and our asset value continuing to go up, now we're making $750K per year, and our asset value based on that income is worth $15 million. Given this scenario, inflation essentially took care of our debt for us. Again, this is an accelerated example, but it paints the picture as to what happens over time with income producing real estate that you can leverage with debt. So I hope this perspective was helpful, and I strongly encourage you to consider the effect that inflation has on your investments and how it can hinder your ability to build wealth over time if you're not investing in the right assets. If you want to learn more, feel free to download my beginner's guide to multifamily investing at rule72equity.com. Thank you.